the last two videos, I talked about inventory velocity and the real cost of holding cards. Now I want to give you a number you can calculate for your own business in about 20 minutes. I call it your stagnant capital ratio. It tells you what percentage of the money you have invested in inventory is currently tied up in cards that were purchased for resale, are not moving, and no longer have a clear plan attached to them. So this is not a valuation exercise, and it's not about what your collection might be worth. It is about how much of your business capital is actively working and how much of it is sitting still. A seller can have $50,000 worth of inventory and still struggle to find $2,000 for the next buying opportunity. It does not necessarily mean the business is unprofitable. It may mean too much of its capital is locked inside inventory that is no longer participating in the operating cycle. The cards still exist. They may still have value. They may even be listed for sale. But if they have sat for a year without meaningful interest, without a pricing decision, and without a reason for continuing to hold them, they are not functioning like active inventory. They are functioning like parked capital. The stagnant capital ratio makes that visible. The formula is simple, okay? Stagnant inventory cost basis divided by total business inventory cost basis multiplied by 100. For example, suppose you have invested 20 grand into the inventory you consider part of your business. After reviewing it, you identify $7,000 in cards that were acquired for resale but have not moved in 12 months and have no clear strategy attached to them. 7,000 divided by 20,000 is 35%. Your stagnant capital ratio is 35%. That means 35% of the money invested in your inventory is not currently participating in the normal operating cycle of your business. That does not mean 35% of your inventory is worthless. It does not mean you need to immediately discount all of it. It means you have identified the part of the business that needs a decision. This calculation should be based on cost basis. Use what you actually invested in the inventory. Do not use your asking prices. Do not use the highest recent comp. Do not use what you believe the cards will eventually be worth. What we're trying to measure is how much of your money is tied up. If you paid $100 for a card, you currently have it listed for $250, the amount of business capital tied up in that card is still $100. The potential upside matters when you decide what to do with it, but it should not inflate this calculation. And the same applies in the other direction. If you paid $500 for a card that is now worth $300, your original $500 is still the capital allocation decision the business made. You may only be able to recover part of it now, but the full cost basis helps explain how the business arrived at its current position. For this first diagnostic, I would use 12 months as the starting threshold. A card is a candidate for stagnant inventory if it was acquired for resale, you have owned or listed it for at least 12 months, it has not sold, it has produced little or no meaningful buyer interest, and you do not have a clear current reason for continuing to hold it. Now, that last part matters because age alone does not make inventory stagnant. Some cards are deliberate strategic holds, and some are showcase inventory, and some are in categories that are sort of naturally sell more slowly. A high-end card may take longer to find the right buyer than a $20 card. The point is not to force every item into the same sales cycle. The question is whether the delay is intentional. So, can you clearly explain why you still own the card, what you expect to happen, and when you will reevaluate the decision? If you can, it may not be stagnant. If the only explanation is, I'm waiting to get my number, it probably deserves a harder look. Do not include your personal collection. A personal card does not need to justify itself as business inventory. It can appreciate, decline, or sit in a box for 20 years. That is a different decision. You should also exclude true showcase inventory if it serves a deliberate purpose for your shop, booth, brand, or customer experience. But be honest about that category. Not every expensive car that fails to sell becomes showcase inventory. Showcase inventory should contribute something identifiable to the business. It may attract attention, establish credibility, anchor a category, or help create an experience customers respond to. You may also exclude strategic holds, but only when there's an actual thesis. Write down what you expect to happen, the time frame, and the condition that would cause you to sell or reevaluate. Eventually, it should go up is not a thesis. Here is how to run the diagnostic. First, pull your complete business inventory. Use your inventory system, spreadsheet, marketplace exports, or whatever records you currently maintain. Include unlisted items if they were purchased for resale. A car does not stop tying up capital because it never made it to your listings. Second, make sure every item has a cost basis. If you do not know the exact cost, use the most reasonable documented estimate you can produce. Do not allow missing data to become a reason to ignore entire boxes of inventory. Third, identify the date each item entered the business. This could be the purchase date, intake date, grading return date, or the point when it became available for sale. Use one rule consistently. Fourth, tag anything that has been sitting for at least 12 months. This creates your review pool. It does not automatically classify every item in that pool as stagnant. Fifth, review those items and assign each one a role. Active inventory, strategic hold, showcase inventory, personal collection, or stagnant inventory. For anything marked strategic or showcase, add one sentence explaining why. If you cannot explain the role, that is useful information. Sixth, add together the cost basis of everything classified as stagnant. Then divide that number by the total cost basis of your business inventory. Multiply by 100. That is your stagnant capital ratio. Let's say a seller has $30,000 invested across all business inventory. During the audit, they find $14,000 in active inventory, $4,000 in documented strategic holds, $2,000 in legitimate showcase inventory, and $10,000 in inventory acquired for resale that has been sitting for more than a year without meaningful activity or a current plan. The calculation is 10,000 divided by 30,000. That seller's stagnant capital ratio is 33.3%. 1/3 of the money invested in the business's inventory is waiting for a decision. That does not mean the seller should hold a liquidation sale tomorrow. The stagnant category still needs to be analyzed. Some items may have bad photos, and some may be listed on the wrong channel. Some may be priced against an unrealistic comp, and some may need to be grouped or repriced, cross-listed, promoted, or brought to an in-person event like your local show. Some may simply need more time, but others may be inventory the seller would never choose to purchase again today. That's usually the most important question in this entire exercise. If you did not already own that card, would you use the business's cash to buy it today at the amount you currently have invested? If the answer is no, continued ownership deserves an explanation. I'm not going to give you a universal good stagnant capital ratio. Different businesses require different inventory profiles. A high volume online seller should probably expect more velocity than a store carrying broad showcase inventory. A vintage specialist will operate differently from a modern single seller. A dealer with strong access to quick turnaround, may have a lower tolerance for slow capital than someone whose advantage comes from long-term category knowledge. The useful comparison is initially against yourself. What is the ratio today? What inventory is creating it? Is it growing or shrinking? And what happens to your available cash as you reduce it? The number gives you a baseline. The decisions come next. Once you have your ratio, do not begin by asking how quickly you can dump everything. Start by dividing the stagnant inventory into 4 action groups. The first group needs better execution. Those are cards with weak photos, incomplete data, poor titles, missing attributes, or limited distribution. The second group needs a pricing decision. The card may have demand, but your number is not aligned with the market or the liquidity you need. The third group needs a different channel. Some inventory performs better at shows, through direct relationships, in lots, through consignment, or on a different marketplace. The fourth group needs an exit. These are cards you would not purchase again, have no clear reason to keep, and are preventing the capital from being used elsewhere. You may not earn the return you originally wanted. That does not automatically make selling a mistake. Sometimes accepting a smaller profit or even a controlled loss is what allows the business to recover the capital and make a better decision with it. Your inventory tells you how much capital you have deployed. Your stagnant capital ratio tells you how much that capital may have stopped working. The formula is simple. Stagnant inventory cost basis divided by total business inventory cost basis. But the real value is not the percentage. It is the list of cards underneath it. Those are decisions your business has been postponing. Run the audit. Get the number. Then decide what deserves more time, what needs a different strategy, and what capital your business needs back. Because simply, inventory should not remain in your business because it is already there.